Tesla's Cybertruck burst onto the scene in November 2019, capturing global attention with its futuristic design and bold promises. The launch was surrounded by intense hype, positioning the vehicle as a game-changer in the electric pickup market. For years, Tesla was seen not just as a car company, but as a cultural phenomenon, often compared to the likes of Apple for its innovation and devoted following. However, this initial excitement set high expectations that would later become difficult to meet. As competition intensified and market realities shifted, the Cybertruck's journey began to reflect broader challenges facing Tesla as a whole. Tesla's Cybertruck entered the market with high expectations, but its sales figures have fallen far short of projections. In 2024, the Cybertruck led electric pickup sales in the United States, yet by 2025, sales dropped nearly 50%, with just over 20,000 units sold. Meanwhile, thousands of unsold vehicles are accumulating in inventory, underscoring a widening gap between anticipated demand and actual consumer interest. Factors such as quality concerns, high pricing, and increased competition have contributed to this disappointing performance. The result is a stark contrast between the initial hype and the reality facing Tesla's electric truck business. Tesla was once celebrated as a cultural icon, often compared to the likes of Apple for its innovation and market influence. Its early dominance in electric vehicles was fueled by groundbreaking technology and a dedicated charging network, setting it apart from traditional automakers. However, as sales and revenue have stagnated in recent years, Tesla's aura of invincibility has begun to fade. Competitors, particularly from China, are now outpacing Tesla in both sales and affordability, offering high-quality EVs at lower prices. This shift has led to growing skepticism about Tesla's ability to maintain its leadership, as the company faces mounting challenges from both the market and its own changing public image. Tesla's valuation has long stood apart from other automakers, largely because investors viewed it as a technology company rather than a traditional car manufacturer. While most car companies are valued based on their sales and profits, Tesla's worth was tied to its perceived innovation and future potential in areas like autonomous driving and energy solutions. This approach led to Tesla being valued at more than 20 times what conventional metrics would suggest, with much of its market cap based on businesses that had yet to generate revenue. Investors believed Tesla's early solutions to industry challenges, such as building its own charging network, justified this premium. Ultimately, Tesla's unique position in the market was driven by the expectation that it would continue to disrupt and lead the automotive and tech sectors. Tesla's ascent in the automotive industry was fueled by its innovative approach to electric vehicles. Unlike traditional automakers, Tesla recognized that the lack of charging infrastructure was a critical barrier to widespread EV adoption. By investing heavily in its own supercharger network, Tesla made long-distance travel feasible for electric car owners, effectively solving the chicken and egg problem that had stalled competitors. This strategic move set Tesla apart, allowing it to attract customers and build a loyal following. The company's focus on both technology and infrastructure demonstrated how innovation can reshape an entire market, turning Tesla from a niche startup into a global leader. Early attempts at electric vehicles faced significant hurdles, largely due to a lack of supporting infrastructure. In the late 1990s, General Motors introduced the EV1, the first mass-market electric car, but it struggled to gain traction because there were few charging stations available. This created a classic chicken and egg problem. Automakers were hesitant to invest in electric cars without widespread charging options, and consumers avoided EVs because they couldn't easily recharge them. As a result, most early electric vehicles failed to achieve commercial success, leaving the industry stagnant until new solutions emerged. It wasn't until companies began investing in dedicated charging networks that electric vehicles started to become viable for everyday use. Tesla's supercharger network was a game-changer in the electric vehicle industry. By investing millions to build fast charging stations across the United States, Tesla solved a critical barrier that had stalled EV adoption: convenient charging infrastructure. While legacy automakers hesitated to spend on a market that barely existed, Tesla recognized that infrastructure was the missing link. This bold move allowed Tesla owners to take road trips and use their cars with the same freedom as traditional vehicles, setting Tesla apart from competitors whose EVs were limited by charging options. The supercharger network not only boosted sales, but also established Tesla as the leader in electric mobility, making it the Apple of cars in the eyes of investors and consumers alike. When Tesla introduced the Model 3, it marked a turning point for electric vehicles. Unlike earlier attempts by other automakers, Tesla had already invested heavily in building a nationwide network of supercharger stations. This infrastructure solved a critical challenge for EV adoption: reliable access to fast charging, making long-distance travel practical for the first time. As a result, the Model 3 generated extraordinary excitement, with over 115,000 pre-orders in just 24 hours and triple that number by the end of the week. The combination of accessible charging and an affordable, stylish electric car set Tesla apart, fueling demand that had never been seen in the industry before. In the early days of electric vehicles, Tesla set itself apart by investing heavily in its own charging infrastructure. While competitors like GM struggled with the so-called chicken and egg problem, few buyers because there were few charging stations and vice versa, Tesla built a dedicated supercharger network across the United States. This move solved a critical barrier for EV adoption, allowing Tesla owners to travel long distances with confidence, while GM's EV1 and others remained limited by charging access. By prioritizing infrastructure, Tesla not only made its cars more practical, but also created a unique value proposition that competitors couldn't easily replicate. This strategic advantage was a key factor in Tesla's early dominance of the electric vehicle market. By 2021, Tesla had firmly established itself as the leader in the electric vehicle industry. The company sold millions of cars worldwide and captured a commanding share of the U.S. EV market, with 3 out of every 5 electric vehicles on American roads bearing the Tesla badge. This dominance was fueled by innovative products, a robust charging infrastructure, and a reputation for pushing technological boundaries. Investors and consumers alike viewed Tesla not just as a car manufacturer, but as a symbol of the future of transportation. Its market position was so strong that it was valued more highly than many traditional automakers combined, reflecting both its achievements and the optimism surrounding its continued growth. Tesla's valuation has long defied traditional automotive industry standards, fueled by investor optimism and a belief in its technological edge. Rather than being valued solely as a car manufacturer, Tesla is seen as a pioneer in autonomous driving and future innovations like robotaxis and energy storage. Much of its market worth is tied to expectations that these emerging technologies will redefine transportation and generate new revenue streams. Investors anticipate that Tesla's data advantage and early investments in infrastructure will give it a lasting lead, even as competitors catch up. This forward-looking logic has kept Tesla's stock buoyant, despite recent declines in sales and market share. A significant portion of Tesla's market value has been tied to ambitious ventures beyond traditional car sales. Instead of being valued like a typical automaker, Tesla's worth has increasingly depended on future technologies such as robotaxis and humanoid robots, businesses that, so far, generate little to no revenue. By 2021, over 96% of Tesla's valuation was based on expectations for these modes, rather than its actual automotive profits. Investors have been betting heavily on Tesla's ability to pioneer autonomous driving and robotics, fueling a valuation that far exceeds its current earnings. This approach highlights how much of Tesla's perceived value rests on unproven innovations rather than established products. The electric vehicle market has seen a dramatic shift as new competitors, particularly BYD, have emerged and challenged Tesla's dominance. BYD, once dismissed by Elon Musk, now outsells Tesla globally, offering a wider range of affordable models with impressive safety ratings. Chinese automakers like BYD have leveraged their control over battery production and supply chains to undercut Tesla on price, making electric cars accessible to more consumers. Meanwhile, Tesla's cost advantage and unique charging infrastructure have been eroded as governments and rivals expanded fast charging networks. As a result, Tesla has been forced to compete on traditional metrics like price and quality. losing market share in key regions while the overall EV industry continues to grow. Tesla's early dominance in the electric vehicle market was largely built on its proprietary charging network, which provided a critical solution to the so-called chicken and egg problem. People weren't buying EVs because there weren't enough charging stations, and companies weren't building stations because there weren't enough EVs. By investing millions in its supercharger network, Tesla made long-distance electric travel possible and gained a unique edge over competitors. However, this advantage didn't last. Governments, rival automakers, and third-party providers began rapidly expanding public charging infrastructure, making it accessible to all EV brands. As the charging gap closed, Tesla found itself competing on price, features, and quality, just like any other automaker. As the electric vehicle market matured, Tesla found itself facing a new reality. The unique advantages that once set it apart, such as its proprietary charging network, became less significant as governments and competitors expanded infrastructure. This shift meant Tesla could no longer rely solely on its brand or early innovations. It now had to compete directly on price, features, and quality. Chinese automakers, for example, began offering EVs at much lower prices without sacrificing safety or performance, forcing Tesla to rethink its strategy. The company's challenge became not just maintaining its market share, but adapting to a landscape where consumers had more choices and higher expectations than ever before. BYD has surpassed Tesla to become the world's leading electric vehicle seller, signaling a significant shift in the global automotive landscape. This milestone reflects the rapid growth and competitive strength of Chinese manufacturers, who have leveraged cost advantages and in-house production to outpace Western rivals. Tesla, once considered untouchable due to its early innovations and charging network, now faces intensified competition as BYD offers a wider range of affordable and high-quality EVs. The industry is witnessing a transformation, with market dynamics favoring companies that can deliver both value and scale. As a result, Tesla's dominance is being challenged, prompting questions about its future position in the evolving electric vehicle market. The global supply chain for electric vehicles is intricately linked to China, especially when it comes to crucial components like batteries and power modules. Western automakers, including Tesla, depend on Chinese firms for the majority of their lithium-ion batteries, which account for nearly 40% of an EV's total value. In fact, about 70% of the world's lithium is refined in China, and Chinese companies produce roughly 80% of all lithium-ion batteries used worldwide. This reliance means that even the most innovative car manufacturers must navigate supply chain vulnerabilities and cost pressures dictated by Chinese suppliers. As Chinese firms expand from component manufacturing to building their own vehicles, they are able to undercut Western brands on price and scale, reshaping the competitive landscape of the EV market. Chinese battery manufacturers have rapidly expanded beyond supplying components, now producing complete electric vehicles themselves. This shift has allowed companies like BYD and CATL to leverage their expertise and control over critical parts, resulting in lower production costs and more affordable EVs. By manufacturing batteries, motors, and assembling vehicles in-house, these firms have eliminated middlemen and undercut competitors on price. Their vehicles not only cost less, but also meet stringent safety standards, making them attractive to consumers worldwide. As a result, competition in the electric vehicle market has intensified, challenging established players like Tesla and reshaping the industry landscape. In China, electric vehicle manufacturers have adopted a strategy known as vertical integration, which means they oversee every step of production, from refining lithium for batteries to assembling the finished car. By controlling the supply chain in-house, these companies eliminate middlemen and reduce dependency on external suppliers. This approach allows them to dramatically lower production costs, making their vehicles far more affordable than competitors. As a result, Chinese automakers can offer high-quality electric cars at prices that are difficult for foreign brands to match. Vertical integration has become a key factor in China's rapid rise as a global leader in the electric vehicle market. Chinese automakers such as BYD have managed to undercut Tesla on price by producing most of their vehicle components in-house, eliminating costly middlemen and streamlining their supply chains. This vertical integration allows them to offer electric vehicles at prices significantly lower than Tesla's, with models like the BYD Seagull starting at just $10,000, nearly a quarter of the price of Tesla's Model 3. Despite their affordability, these vehicles have achieved high safety and quality ratings, with BYD's Seal, Dolphin, and Tang earning perfect 5-star scores from Euro NCAP, one of the world's toughest safety standards. By controlling lithium refining, battery production, and assembly, BYD and its peers have not only matched Tesla's quality, but also made electric cars accessible to a broader market. As a result, they have rapidly gained market share, challenging Tesla's dominance in the global EV industry. Tesla's dominance in the electric vehicle market is being challenged as Chinese automakers rapidly expand their presence worldwide. Companies like BYD are offering affordable, high-quality EVs, undercutting Tesla's prices and matching its safety standards. By producing key components in-house and leveraging economies of scale, these manufacturers have driven costs down to levels Tesla cannot easily compete with. As a result, Tesla's global market share has dropped significantly, falling from first to third place in just a few years. The influx of competitive Chinese EVs has reshaped the landscape, forcing Tesla to confront new realities in pricing, quality, and consumer preference. U.S. tariffs were designed to shield Tesla from foreign electric vehicle competitors, particularly those from China. While these measures did limit the influx of cheaper imports, they failed to address the core challenges Tesla faces. Chinese automakers have managed to undercut Tesla's prices globally by controlling their supply chains and producing vehicles at scale, making them highly competitive even outside the U.S. Meanwhile, Tesla's market share continues to shrink as domestic rivals like Ford and GM gain ground and international players expand their presence. Ultimately, tariffs alone cannot compensate for Tesla's pricing disadvantages, quality concerns, and the loss of government incentives, leaving the company vulnerable in an increasingly crowded market. In 2025, new legislation in the United States dramatically altered the landscape for electric vehicles by removing crucial government supports. The Trump administration reversed the previous goal of having 50% of new cars sold be electric by 2030 and eliminated federal tax credits that had made EVs more affordable for consumers. Additionally, penalties for automakers failing to meet fuel economy standards were lifted, ending the lucrative system of regulatory credits that companies like Tesla relied on for a significant portion of their profits. Without these incentives, the financial appeal of electric vehicles diminished, leading to increased challenges for manufacturers and a slowdown in EV adoption. These policy changes have forced automakers to rethink their strategies in a market now shaped more by competition and consumer demand than by government intervention. For years, regulatory credits played a pivotal role in Tesla's profitability. By selling only electric vehicles, Tesla accumulated surplus credits, which other automakers needed to offset their less efficient fleets. This arrangement provided Tesla with billions in pure profit, making regulatory credits one of its most lucrative income streams. However, recent policy changes eliminated these credits and removed penalties for fuel economy violations, abruptly ending this revenue source. As a result, Tesla's profits took a significant hit, highlighting how dependent the company had become on government incentives rather than just car sales. Tesla has faced a significant financial setback due to recent regulatory changes. The elimination of federal EV tax credits and penalties for automakers violating fuel economy standards has removed two major sources of profit for the company. For years, Tesla benefited from selling regulatory credits to other automakers, generating billions in pure profit. With these credits and incentives gone, analysts estimate Tesla's earnings could fall by as much as 52%. This shift underscores how dependent Tesla's business model was on government support and highlights the challenges it now faces in maintaining profitability amid intensifying competition. Elon Musk's political involvement has created unexpected financial challenges for Tesla. After supporting controversial political figures and causes, Musk faced backlash from key markets, notably in Germany and the United States, leading to steep declines in Tesla's sales. The situation became even more ironic when the Trump administration, which Musk had publicly supported, enacted policies that removed crucial government subsidies and regulatory credits for electric vehicles. These changes wiped out billions in revenue streams that had previously bolstered Tesla's profits. Ultimately, Musk's political actions not only alienated a significant portion of Tesla's customer base, but also undermined the company's financial stability. Elon Musk's personal brand has long been intertwined with Tesla's identity, attracting customers who admired his vision for sustainable innovation. However, recent controversial statements and political endorsements have sparked backlash among key consumer groups. In Germany, Musk's support for far-right parties led to a dramatic 60% drop in Tesla sales, while similar incidents in the UK and Canada resulted in declining interest. In the United States, his public approval of Donald Trump caused a sharp decrease in Democratic buyers, shifting Tesla's appeal away from its traditional base. This shift illustrates how Musk's actions, once a source of strength, now pose significant challenges for Tesla's market position. Tesla's customer base has historically leaned toward environmentally conscious, left-leaning buyers who admired Elon Musk's vision for sustainable innovation. However, recent political statements by Musk, including his support for controversial parties and causes, have triggered significant backlash. In Germany, sales plummeted by 60% after Musk endorsed the far-right Alternative for Germany party, and similar declines followed in the UK and Canada after political interventions. In the United States, the percentage of Democrats considering a Tesla dropped sharply, while increased interest from Republicans failed to offset these losses. This shift highlights how a CEO's public persona can profoundly impact consumer sentiment and sales, especially when the brand is closely tied to its leadership. Tesla's relationship with its CEO, Elon Musk, is unlike that of most other companies. A significant portion of Tesla's investors are more loyal to Musk himself than to the company, making his leadership a cornerstone of its identity and valuation. Surveys have shown that if Musk were to leave, Tesla's stock and overall value could suffer a dramatic decline. This deep-rooted loyalty complicates any potential succession plans, as removing Musk could trigger instability among both shareholders and customers. As a result, Tesla faces unique challenges in adapting to changing market conditions, since its future remains tightly bound to Musk's public persona and decisions. Tesla is facing a convergence of challenges that threaten its dominance in the electric vehicle market. The once exclusive charging infrastructure has become widely available, eroding a key competitive advantage. Chinese automakers now produce EVs at lower costs, outpacing Tesla's ability to compete on price and quality. Government subsidies and regulatory credits, which previously bolstered Tesla's profits, have been reduced or eliminated, impacting financial performance. Meanwhile, Elon Musk's polarizing public statements have alienated segments of Tesla's customer base, adding to the company's difficulties in maintaining market share. Tesla's legacy as a trailblazer in electric vehicles is undeniable. The company solved critical challenges, such as charging infrastructure, and inspired an entire industry to shift toward sustainable transportation. However, being the first to innovate does not always ensure continued dominance. As competitors catch up and surpass Tesla in affordability, quality, and market share, the company faces new realities that threaten its position. The story of Tesla highlights that early success must be followed by ongoing adaptation to maintain leadership in a rapidly evolving market. Tesla has increasingly shifted its focus toward new ventures such as autonomous vehicles, robotaxi services, and energy storage, aiming to diversify beyond its core electric car business. Despite declining sales and shrinking market share in the EV sector, investor enthusiasm for these future innovations has kept Tesla's market valuation remarkably high. Much of the company's worth is tied to expectations about technologies that have yet to generate significant revenue. This disconnect between business fundamentals and market value reflects the belief that Tesla will pioneer breakthroughs in emerging industries. However, as competition intensifies and regulatory support wanes, questions persist about whether these ambitious pivots can justify the company's lofty valuation. Tesla's journey from industry trailblazer to its current crossroads highlights the unpredictable nature of innovation-driven markets. Once untouchable thanks to its charging network and visionary leadership, Tesla now faces mounting challenges from global competitors, shifting consumer sentiment, and regulatory changes. Despite its ambitious pivot toward new technologies like autonomous vehicles and energy storage, investor optimism remains disconnected from the company's declining sales and shrinking market share. The question is no longer about how high Tesla can climb, but whether it can maintain its foothold amid intensifying competition and internal controversies. As the electric vehicle landscape evolves, Tesla's future is increasingly uncertain, and its ability to hold on to what remains is far from guaranteed.